Most people look at their paycheck and feel confused. The number they negotiated for is not the number that arrives. This happens to nearly every working American. And almost nobody talks about why. You make $60,000. And after taxes, you're holding $45,000. You make $100,000. And the gap widens in a way that doesn't make intuitive sense. The math feels broken. But it's not random. It's a system. And like most systems, once you see how it actually works, the confusion turns into clarity. The federal government collected nearly $49 trillion in revenue in 2024. You make $100,000, and the gap widens in a way that doesn't make intuitive sense. That's not millions. That's trillions of dollars pulled from paychecks, businesses, and investments across the entire country. Most people think about taxes as this single thing that happens on April 15th. But taxes are a year-round machine operating in the background of every paycheck, every purchase, every investment decision you make. In a minute, it'll show you exactly where that money comes from and how the system decides what you actually owe. But the last part changes everything about how you should think about your paycheck. Here's the first thing that surprises most people: individual income taxes. The money taken from your paycheck account for about 49% of all federal revenue. That's $24 trillion pulled directly from working people. But that's only half the story. Payroll taxes, the FICA amount you see on your stub, make up another 35%, or $17 trillion. Together, the money from paychecks covers about 84% of what the federal government spends. Corporate taxes, despite being a major headline topic, only contribute about 11%. When you realize this, something clicks. The conversation about federal revenue is almost entirely a conversation about your asterisk paycheck. This is where most people start to feel the weight of it. You're not just paying income tax. You're paying Social Security tax at 62% on wages, up to about $176,000. You're paying Medicare tax at 145% on all wages, with an additional 0.9% if you earn over $200,000. That's 765% of your gross income before income tax even enters the calculation. If you're self-employed, you pay both sides of that 765%, 153%, because you're technically both the employer and the employee. Most people don't realize this until they run their own business or gig work for the first time. Then the math becomes very real very fast. Now here's the twist. The federal income tax system doesn't work the way most people think it does. It's not a flat percentage. It's a progressive system built on brackets. The way brackets work is this: you don't pay one rate on all your income. You pay different rates on different portions of your income. If you earn $50,000 in 2025 as a single filer, the first $11,600 is taxed at 10%. It's not a flat percentage. Everything above that threshold is taxed at 22%. You never pay 22% on your entire income. You only pay 22% on the portion that lands in that bracket. This is a staircase, not a cliff. Most people get this wrong and think they'll somehow make less money by crossing into a higher bracket. That's the thing nobody explains clearly until it's too late. Here's where it gets expensive. Once you understand brackets, you start asking what actually gets taxed. The answer is your taxable income, not your gross income. This is the gap between what you earn and what gets taxed. That gap is created by deductions. A deduction reduces the amount of income the government taxes you on. The standard deduction for a single filer in 2025 is $15,000. This means if you earn $50,000, you only pay tax on $35,000. That $15,000 disappears from the taxable calculation. Most people take the standard deduction because it's simple and it's usually larger than itemizing deductions on your own. But some people choose to itemize instead. Itemizing means you add up specific expenses: mortgage interest, property taxes, charitable donations, state and local taxes up to $10,000, and use that total as your deduction instead of the standard amount. If your itemized deductions exceed the standard deduction, itemizing saves you money. But for most Americans, it doesn't, so they take the standard deduction and move on. Now here's the key thing people miss. Deductions and credits are not the same thing. A deduction lowers your income before tax is calculated. A credit lowers your tax bill after it's calculated. A credit is almost always more valuable because it directly reduces what you owe. The child tax credit is $2,000 per child, under 17. If you earned $50,000, owe $4,000 in taxes, and have one child, you subtract $2,000 from what you owe. You now pay $2,000 instead of $4,000. But here's the twist that changes the math entirely. The child tax credit is refundable. That means if your tax credit is larger than the tax you owe, the government sends you money. If you earn $30,000, owe $1,000 in taxes, and have one child, you get the full $2,000 credit, you pay zero in taxes and receive a $1,000 refund. This is one of the few times the tax system actively sends money *to working people instead of taking it away. The Earned Income Tax Credit, or EITC, works the same way. For low to moderate income earners with children, this credit can be $3,600 or more. For a family making $35,000 with 2 children, the EITC can mean a refund of $3,200 or more. Many families rely on this annual refund as a financial event, a chance to catch up, buy something they need, or finally build a small emergency fund. But then April passes, the money is spent, and by June, the monthly grind has returned. This is the rhythm most Americans live in. Most people miss this part entirely. Now let me show you why the distribution of who pays what matters. The tax bracket with the most filers, over 53 million people, is the 12% bracket. These are people earning roughly $47,000 to $100,000 as single filers. As single filers, this is the heart of the American workforce. But here's where the system reveals itself. The top 1% of earners pays about 40% of all federal income taxes. The top 3% pays roughly 50%. The bottom 50% of earners pays only about 3%. When you see this breakdown, the progressive system becomes visible. It's not hidden anymore. It's deliberate. The government's entire income tax strategy depends on higher earners paying substantially more. Without this concentration of tax revenue from the top earners, the system wouldn't function at all. But this also means the system is extremely sensitive to changes at the top. When policy shifts the rates or brackets for high earners, it changes the entire federal revenue picture. This is the part nobody notices. Capital gains taxation operates on a completely different system than regular income. When you sell an asset for more than you paid for it, that profit is a capital gain. If you held that asset for more than 1 year, it's a long-term capital gain, taxed at preferential rates 0%, 15%, or 20%, depending on your income. These rates are typically lower than ordinary income tax rates. This is the part nobody notices. This creates an enormous advantage for people whose income comes primarily from investments rather than wages. A person earning $500,000 in wages pays tax at higher rates than a person earning $500,000 in long-term capital gains. The difference can be tens of thousands of dollars per year. Most working people don't benefit from this system because their income is wages, not investments. Their paycheck is taxed at ordinary rates, with no preferential treatment. This is the silent wealth transfer embedded in the tax code. And it's been there so long that most people don't even realize they're experiencing it. Most people experience this disconnect without understanding its source. Then the narrative shifts when you hit certain income threshold. If you earn over $200,000 as a single filer, you're subject to an additional 38% Medicare surtax on net investment income. This was part of the Affordable Care Act passed in 2010. Most people never hear about it until they cross that threshold. Then suddenly their investment income is being taxed at a higher rate than they expected. The system doesn't announce these thresholds. You discover them when you file taxes, or when an accountant explains it to you. By then, the damage is already done. This is the part where history matters. The tax code wasn't always this complex. In 1986, the Tax Reform Act simplified the system significantly. Before that, there were 14 different tax brackets. After the reform, there were just 15% and 28%. The system was cleaner, harder to manipulate, easier to understand, but complexity crept back in over the following decades. By 2017, when the Tax Cuts and Jobs Act passed, the brackets had expanded again. The individual tax cuts in that law reduced rates and simplified brackets temporarily, but there's a catch that almost nobody knows about. Those individual tax rate cuts are set to expire at the end of 2025. If Congress doesn't act, taxes automatically return to pre-2017 levels for most individual filers. Your effective tax rate could increase by 1% to 5%, depending on your bracket. For a single filer earning $75,000, this could mean an additional $500 to $1,200 per year in taxes. Most people aren't planning for this because the news hasn't made it a story yet. But the calendar is ticking. Here's what's different about corporate taxes. In 2017, the corporate tax rate dropped from 35% to 21% permanently. For a single filer earning $75,000, this could mean an additional $500 to $1,200 per year in taxes. Corporations now pay a flat 21% federal rate on profits, but corporate taxation is also more complex than it appears. There's an alternative minimum tax designed to prevent companies from using deductions and credits to eliminate their tax bill entirely. Some large corporations use strategies, R&D credits, depreciation deductions, loss carry-forwards to reduce their effective tax rate to almost nothing in certain years. This is legal but often invisible to the public. When headlines mention a major corporation paying zero federal income tax, it's usually because of these legal strategies working exactly as designed. The strategies exist in the code deliberately. Most people find this unfair until they realize this same logic applies to their own life. If you can reduce your taxable income through deductions and credits, you're using the same system corporations use, you're just doing it at a smaller scale. The difference is scale and complexity. A corporation has an army of accountants optimizing every dollar. An individual has a form and a standard deduction, but the principle is identical. Lower taxable income, pay less tax. Now here's where state and local taxes enter the picture. On top of the federal $49 trillion collected in 2024, state and local governments collected another $24 trillion. Some states have no income tax. Texas, Florida, Nevada, Tennessee, and others. Instead, they rely on sales taxes, property taxes, and corporate taxes. Other states have income tax rates ranging from 1% to 133%. California's top rate is 133%, the highest in the nation. A person earning $200,000 in California pays 133% to the state plus federal tax, reducing take-home by roughly $40,000 more than someone in Texas. This geographic tax arbitrage is why some high earners move to no-income tax states in retirement. It's not a secret strategy, it's just basic math. But most working people can't move for tax reasons. They're in a specific job market, with family ties, with a home, so they pay what their state requires and don't think much about it. This is the reality most people operate in. Taxes are taken by law, not choice. Most people never optimize their tax position because they assume the system does it for them. But the system doesn't optimize anything. The system collects what the law requires. Anything beyond that is left to you. This is where it gets real. Tax filing creates a moment of reckoning for most people. You add up your income, subtract your deductions, calculate what you owe, and then file. For many, the government has already withheld the correct amount from your paycheck throughout the year. Your refund is essentially the government giving back money you overpaid. The average refund in recent years is around $3,000. That's significant money. But it also means most people gave the government an interest-free loan for an entire year. They could have had that $250 per month in their bank account, earning interest or preventing debt. Instead, they filed taxes, got a refund, and called it a win. The psychology of the refund is powerful. It feels like free money, even though it's just your own money returned to you. This psychological trick makes people feel good about a system that actually took their money and delayed returning it for 12 months. Most people don't adjust their withholding because the refund feels like a reward. Some people actually appreciate overpaying taxes if it means a bigger refund check. This is how the system survives without complaint. Here's the last thing that changes everything. The timing of deductions and documentation creates hidden pressure throughout the year. If you own a home, you need to track mortgage interest. If you donate to charity, you need receipt. If you're self-employed, you need to track every business expense. If you have children, you need to document childcare costs for the dependent care credit. This mental load is invisible to most wage earners. But it's very real. You're not just paying taxes, you're managing documentation to justify paying less tax. Most people don't have systems to track this, so they either pay more tax than they need to, or they miss deductions entirely. The system rewards people who stay organized and punishes people who don't. But organization requires time, energy, or money to hire someone to do it. This creates another invisible cost. 3 clear truths emerge once you pull back from all the complexity. Federal income comes almost entirely from individual paychecks and payroll taxes. The progressive tax system concentrates revenue on higher earners, which means your wealth-building strategy should account for tax efficiency at your specific income level. The gap between gross income and take-home income is created by 4 forces: federal income tax, payroll tax, state and local taxes, and the deductions and credits you do or don't use. Once you understand these 3 things, you can start thinking about your paycheck differently. It's not random, it's calculated, and calculation means there's a strategy embedded in it. If you want to keep more of what you earn, you need to understand this system deeply enough to work within it, not against it. That's the real reason tax knowledge matters. It's not about finding loopholes or being clever. It's about seeing the system for what it is and making decisions that align with your actual financial situation, not just hoping for a refund at the end of the year. A qualified tax professional can confirm this and help you map your specific situation to make sure you're not overpaying. That's the quiet power of understanding taxes clearly. It gives you back control over a system that's designed to be confusing. If you use it, here's what qualifies and what doesn't. Distilled to the core, qualifies voluntary tips from customers, tips reported through employer channels, tips received via card or digital payment, unreported cash tips you can document with contemporaneous records. Doesn't qualify mandatory service charges added to bills, tips from other employees, tips paid by the business itself, tips in kind, free meal, free drink. Doesn't eliminate payroll taxes. State income taxes varies by state. AGI for other tax calculation. This is the clean version. But the practical version is messier. Because the IRS has never clearly defined what documented unreported cash tips means. Is a note on a napkin documentation? Is a text message to a friend? Is a phone recording? The honest answer is uncertainty. Most tax professionals recommend a consistent written log with dates and amounts, but even that might not survive an audit if the IRS questions whether the amounts are reasonable. Here's an example. You claim you made $25,000 in cash tips as a pizza delivery driver, but your W-2 shows $18,000 in wages. The IRS sees that and thinks, is this credible? For a delivery driver in a market where $25,000 is realistic, yes. For someone in a slow market where you can possibly make that much. Nope, credibility matters in tax disputes, and credibility lives in the details of your records. That's why this matters for three specific worker types: restaurant servers, where tipping is dense and expected, baristas, where cash tips stack up over time, and personal service workers like hairdressers or massage therapists, where repeat clients tip regularly. For these groups, documenting tips feels natural. For someone in a less tipping-focused role, it's unfamiliar, and unfamiliarity is where mistakes happen. Let me close the loops I opened at the start. The IRS made this move because tipped workers have historically underreported income, both voluntarily keeping cash off the books and involuntarily because the system offers no incentive to report. This deduction is the carrot. It says report your tips, and we'll give you a break. It's an attempt to bring more tip income into the formal tax system while giving workers relief. Whether it works depends on whether service workers actually know about it. So far, and the part that changes what you can actually claim is the phase-out rule. You can just claim $25,000 and walk away. If you're a successful, high-earning server making $300,000 total income, you get zero benefit. This deduction only helps workers under about $150,000 in annual income. That's the real guardrail, and it tells you that Congress was thinking about a specific population when they wrote this, not the wealthy, the working class and lower middle class in service roles. That focus means something. It means the rule is designed to be fair, not universal. It helps the people who actually need it. Now, three things to remember. The deduction saves you federal income tax, but not payroll tax. It only exists until the end of 2028, and documentation is everything. Without contemporaneous records, you're exposed. With them, you're protected. That distinction is the gap between a clean claim and an audit. Here's what I'd do if I were in a tipped position right now. Start a simple tracking system. At the end of every shift, write down your tips and where they came from. If you're using a phone, a notes app works. That distinction is the gap between a clean claim and an audit. Include the date, the amount, and whether it was cash or card. Then, every quarter, add up your totals. This serves two purposes. It gives you an idea of your annual tip income as the year progresses, and it creates the documentation trail you need in case of an audit. The second step is understanding your personal phase-out threshold. If you're single and your income is trending toward $150,000, you need to know that, because that's when the deduction starts to shrink. A tax pro can walk you through this, but the basic idea is plug your numbers into the formula and know where you stand. The third step is filing this deduction on your return. When tax time comes, don't let it slip by. This isn't a nice-to-have thing to explore later. It's a limited time benefit with specific rules. If you miss claiming it 1 year, you can usually file an amended return within 3 years. But that's extra work. It's better to get it right the first time. Here's the quiet thing nobody says about tax deductions. They're not complicated because they're designed to be. They're complicated because the system evolved over 100 years with no central redesign. Congress added rules on top of rules, on top of rules. The IRS tried to clarify. Tax lawyers specialize, and now normal people feel like they need an advanced degree to claim money they're entitled to. This deduction is simpler than most, but it's still surrounded by rules and phase-outs and documentation requirements. That friction is why most people don't claim it. Not because because it feels like too much work, but 4 years is short, and thousands of dollars is real money. So it's worth the friction. Your move is simple. Find out if you're in a qualifying occupation, track your tips going forward, document everything, and file the deduction when tax time comes. That's it. 3 things to lock in this deduction. Reduces federal income tax, not payroll tax. It expires after 2028, and it only helps workers earning under roughly $275,000 annually. The rest is mechanic. If you're in a tipped role and this is new information, start tracking your tips this week. Your move is simple. Find out if you're in a qualifying occupation, track your tips going forward, document everything, and file the deduction when tax time comes. This week, a notebook, a note app, or a spreadsheet is enough. The earlier you start, the cleaner your documentation looks, and the safer you are if the IRS asks questions. And if you're not sure whether you qualify, or if your situation is unusual, a tax pro can run the numbers for your specific case.